In this video, we will talk about basics of investing, where to invest, the benefits of investing, different options available out there, the risk associated with it, and things to consider. Please note this content is for educational purposes only, and if you need a specific tailored financial advice, I highly recommend you reach out to a financial planner. Hi everyone, welcome to my channel. For those who are new to my channel, I'm Anna, senior finance professional and chartered accountant turned personal performance coach, helping people to score 360 success in life. Personal finance is one of the aspects I educate my clients on. I have previously done a few videos on the topic of personal finances, financial habits, mindset, how to do savings and budgeting, so now it's a great time to talk about how we can make our money grow. Let's look at fundamentals. I've heard it time and time again. Investing is only for the wealthy, or it's too complicated, or it requires extensive knowledge of finance. But the truth is, investing is for anyone who wants to take control of their financial future. It's not rocket science, and you don't need a degree in finance to get started. In fact, most of the wealthiest people in the world started with very little, but they had one thing in common: they started early. Another common misconception is that you need a lot of money to start investing, but that's not true. You can actually start with as little as $100. The key is to start small, be consistent, and be patient. Investing is a long-term game, and it's not about getting rich quick. It's about building that wealth over time, and anyone can do it. So why would you invest? Why can't you just take and save money in the drawer at home? Because money needs to work. What I mean is that if you take $50 today and leave it in the drawer and forget about it for 2 years, in 2 years' time, this $50 will be worth much less than what it is now. Why? Because of a thing called inflation. Money tends to devalue over time. So, as an example, 8 years ago, I was able to buy this Lavazza coffee at 25 Australian dollars per 1 kilogram in Sydney. Now, the price of that coffee is roughly $50, which is double, only after 8 years. So, in order for us to protect our money, we have to invest the right way for money to generate more money. You can ask me, okay, why can't I just put my money into savings account? You can, and it is definitely much better than keeping it in the drawer, as it will give you roughly 4% at the moment return per annum, which is better than zero. But if you invest in index funds, let's say, your return over the course of 10 years will be roughly 10% per annum, which I will talk about in a second. Which means your money will make much more than being kept in the savings account, or even worse, in the drawer. So let's talk about some of the most popular investment options available in 2024. Stocks, bonds, cryptocurrencies, index funds, and real estate are some of the most common ways to invest your money. Stocks allow you to own a piece of your favorite company. Bonds provide a fixed income stream. Index funds offer a diversified portfolio, and real estate provides a tangible asset. Each of these options has its pros and cons. Let's start with the simplest option, real estate, which is pretty much when you own a portfolio of the properties and you rent it out, which means you are getting a return in the form of rental income. What you also get, hopefully, is appreciation in the value of those properties over the long term. This is a long-term game with a great barrier to entry, which means you need to meet two conditions. You need to have a significant amount of capital available to start with in order for you to get into that market. And condition number two is that you need to keep those properties for quite some time in order for you to realize that appreciation and see the benefit. Your rental yield, which is the amount of money you make on an investment property by measuring the gap between your overall costs and the income you receive from renting out your property, will also depend on many variables, such as the type of property you own, the area where you own it, the condition, the infrastructure in the area, and so on. Many real estate sites will have information about the rental yields and area growth metrics. So if you want to start exploring it, you can actually do some research before you even go and speak to a real estate consultant. Now let's talk about stocks. This is when you decide to buy stocks and shares of publicly traded companies. Let's say you want to buy some Apple or Microsoft shares. Obviously, you can't just jump online and go to their website and buy their shares. But what you can do is that you can use a broker to do that. So I'm not a big fan of this option and have personally lost money on this one. So you need to spend hours to understand the market, the risks, which companies to invest, understand their financial position. And I just don't have the time to spend on understanding. And I probably wouldn't recommend it to anyone unless you're some kind of financial markets guru. But what you can do instead, and what Warren Buffett recommends in one of his interviews when he was asked how people can start investing, is that you can start investing in index funds.
I'd like to ask both of you, if you were 30 years old again and had your first million in the bank, how would you invest it, assuming you're not a full-time investor, you have another full-time job, you can cover your expenses with other savings for about 18 months, no dependents?
Well, I'll be very simple. With under the conditions you name, I'd probably have it all in a very low cost index fund, and it'd probably be, might be Vanguard, somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor.
By the way, if you like this video and learned something new, I highly appreciate if you subscribe to my channel, as there will be more videos on their financial independence and how to build more wealth coming out in the next couple of weeks. Thank you. Now let's talk about index funds, ETFs, and mutual funds. So what are these things and how can you invest in those? Think of these funds as a basket of different stocks. So basically, the biggest benefit of those funds is that you get to diversify your risks. You invest not just in one company, but in a few. For example, one of the most recommended funds to invest in is S&P 500, which has the shares of the top 500 companies of the world, from Apple to Ralph Lauren. So if you look at the performance of S&P over the period of last 70 years, we can see that the index has returned a historic annualized average of around 10.26% since its 1957 inception through the end of 2023. Yes, it has its ups and downs, but if you keep it long term, and again, investing is a long-term game, you will definitely make money. The chances are pretty low that all of those 500 companies will go in default at the same time. And because you have diversified your portfolio, it means you're covered. So what is the difference between index funds, ETFs, and mutual funds? Mutual funds are actively managed by professional brokers, and it means the commission that you will need to pay will be slightly higher, around 1% of your total portfolio per annum. And imagine if you have a portfolio of 100K, you will pay roughly $1,000 in commission, which is kind of high. And you can't always be sure that you will actually make that return through your portfolio growth in that particular year. Whereas ETFs and index funds have a relatively low commission, around 0.2%. So what is ETF? ETF stands for Exchange Trade Fund. ETFs is very similar to index funds, but the difference is that they can be traded throughout the day when stock exchange is open, which means it gives you a bit more flexibility to buy and sell and earn some margin on it. An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. Index funds can be traded once per day based on the average value at the end of the day. Quite often, index funds will have minimum investment required. Vanguard, which is quite a big broker and platform, has a very minimal requirement. For example, I think it's $200. But what is great about them is that you don't have to monitor them regularly. You just invest and forget. You set up dividend reinvestment, which in its turn will give you a maximized impact of compounding interest. You can invest through big platforms like Vanguard, which I use, and you can read everything about index funds. They offer commissions and potential returns for you to make a well-thought decision. For example, here is one of the index funds which I have invested in, and it gives you an idea about returns, commission, composition of stocks, and all the other information you might need. One of the most critical insights for beginners is the power of compound interest. Compound interest is the concept of earning interest on your interest. And it's what makes investing so powerful. When you start investing early, your money has time to grow and the returns can be significant. So, my recommendation is to start doing it now. Go spend some time, figure out how it works, set up that Vanguard account or whatever platform you want to use. Look for the fund that has the lowest commission and will give you the returns based on your risk preferences and risk appetite. Set up that auto transfer from your regular day-to-day account into your investment account, because the earlier you start, the more money you're going to build over the course of the years. Don't be discouraged if you don't see immediate results. Investing is a long-term game, and it requires discipline, consistency, and patience. In summary, investing is not just for the wealthy and it's not too complicated. It is a way to take control of your financial future, achieve your goals, and build wealth over time. Whether you're 25 or 55, it's never too late to start investing. Recently, I was talking to one of my coaches who just started investing at the age of 50. By the time she will be 60, when we have done her numbers, she will have around 60K, which is better than nothing, right? So it's never too late. Investing is also not just about making a lot of money, it's about achieving your financial goals. Whether it's saving on it for a down payment on the house or building a plan for your retirement or just having that financial safety net, the earlier you start, the better. Thanks for watching, and I hope you learned something new today. If you have any questions about investing, leave them in the comments below. And if you want to learn more about saving strategies, be sure to check out this video here where I talk about financial habits and saving strategies. As always, rooting for your success with care, Anna.